Federal Reserve Chair Jerome Powell said policymakers could hike rates 2 more times this year as the central bank works to control inflation. Joining us now is Steve Hanke, professor of applied economics at John Hopkins University and senior fellow at the Independent Institute. Welcome to the show, Steve.
Great to be with you again.
All right, we got to talk about what happened over the weekend. Russia briefly faced the threat of an armed insurrection. Can you unpack the significance for us when it comes to the economy in relation to what's going on in Russia?
Well, no. There's a lot. There's a lot of talk and conjecture. But as I listen to people, it's kind of amusing because they clearly are clueless and have no idea whether this is going to be, the narrative is, oh, this is very negative for Putin, but maybe there's another side to the coin. Maybe it's going to be very positive for Putin. I have no idea, and listening to people, I'm convinced they have very little idea also.
Nonetheless, it sort of speaks at least to a bit of uncertainty when Russia itself has tanks going up the highway towards Moscow. And of course, when we talk about Russia, we have to talk about the energy markets. And we saw obviously a small blip in oil prices, and that has a long-term effect. Potentially, at least higher energy prices, of course, have some effect, as we know, on consumer spending in the United States and elsewhere. Do you think that if there is prolonged uncertainty with Russia, already now we're a year into this war, we had obviously some embargoes put in place, etc., that this would cause long-term sort of let's say an extra bump in interest rates, if you will, that a little bit of a stifling of the economy as it goes on?
Again, we're getting into such speculative territory. Maybe, Lawrence, the best way to put it is, as you phrased it, it does throw some uncertainty into markets. There's no question about that. And that gets that does get priced in. So,
speaking of that I'm sorry.
No, that's I agree with you. It does throw uncertainty into the market, but how much and actually how it gets priced in, I'm not really very clear about that. So I really have very little to offer.
That's all right. Well, I on the domestic front, of course, we've seen over the past few months that the higher interest rates have caught some of the local banks, the regional banks off guard. They apparently didn't know that could happen, and their bond portfolios were set up for, with high duration. And we also now are seeing a bunch of commercial mortgage-backed securities coming due, mortgages coming due, which will affect the CMBS market at a time when vacancies are higher than pre-pandemic level. Obviously, fewer people coming back to the office, fewer people wanting to rent commercial real estate, and high mortgage rates kind of scaring off potential buyers because it raises the hurdle rate. Do you think that all of these factors are going to accelerate a recession by, let's say, Q4?
Yes, I do, because the nub of the problem here that most people aren't focused on, and you almost see nothing about it even in the financial press, is that the money supply is contracting. And we've never seen a contraction like we have at present since 1938. So it's a very unusual situation where you have year over year broadly based money supply measured by M2 contracting by 4.6% year over year. And the biggest contribution, by the way, to M2 is banks. Banks produce most of the money. Deposits at banks account for 82.5% of all M2. And the banks are reining things in. The contribution of banks is only growing at about 1.7% year over year. That's a very slow rate of growth. And if you look at the 3-month annualized rate, it's down a negative 4.5%. So we've got broad money contracting in an unprecedented way. And the biggest engine for that and contributor are commercial banks, and they're slowing way down. And you mentioned the Silicon Valley and the other two banks that went down, banking problems. And the reaction from Washington is that they want to increase the capital asset ratios of the banks. They want to recapitalize the banks, force them to recapitalize. Now, this is very disinflationary, and it really puts a squeeze also on credit. So that's why I think we're headed for a recession. Probably we'll see it coming last quarter or first quarter of next year, and it could be fairly severe. Usually, Lawrence, there's a lag of between 6 and 18 months between changes in the money supply and economic activity. And the peak of the money supply, M2, was in July of last year. So we're kind of in the zone where things could start slowing down fairly fast.
Do you think the Fed was prepared for it itself? Do you think that knowing that they were raising rates like this, and knowing that it was going to put pressure on banks to slow down their lending and to cut back what they were doing and cut back on credit, do you think that they had an intention of potentially causing a collapse, at least, or some sort of disbalance, if you will, in the real estate market, similar to what we had in 2008, where we had, I mean, granted, it was a different story back then, a slightly different story, but nonetheless, it was a real estate catastrophe, of course, which accelerated a financial crisis. Do you think that they sort of know that there could be that risk coming up?
I don't think they know what they're doing. They are not following the quantity theory of money. They're not watching the money supply, and they have said they aren't. Powell has repeatedly said that changes in the growth in the money supply have very little connection to economic activity, which is complete rubbish. But he keeps saying this over and over again. And if you read the press, now remember, they didn't anticipate inflation. They goosed the money supply in 2020, 2021. We got, of course, with a usual lag, a lot of inflation, and now the inflation's coming down because, again, with a lag, we have this contraction in the money supply. But if you read the press, what's in the press? The press is, now, instead of inflation being temporary, which they gave us all a propaganda about that initially, now they say it's persistent. It's going to be with us forever, and we're going to have a big fight on our hands to get it down. If you read, even last week, the BIS came out with a big report indicating that the world is in the grips of inflation. It's going to be very hard to wring it out of the international economy. And if you read all the newspapers, that's all they're talking about. But they talk about, Lawrence, non-monetary causes of inflation. Inflation is always caused by changes in the money supply, every place. But what do you read in the paper? They come up with one more non-monetary explanation for inflation almost weekly. You know, Beyonce is causing inflation in Sweden. I hope you read about that.
I have not yet, but
yeah, well,
I wouldn't. I would accept.
It was in the front page of the Financial Times last week.
Professor, we have to ask you, you tweeted back in May that Bitcoin is a bubble, it has no inherent value, and is terribly overpriced. Has your mind changed given that BlackRock, the largest asset manager, has filed for a spot ETF?
No, it hasn't changed. I didn't say. I don't think I said it was a bubble. I said it was a highly speculative asset. Which, listening, even Katie. Now Katie's clearly an expert. You just had her on, and knows what she's doing. And you ask her about a forecast, and she wouldn't give you a forecast because she's smart enough to say that it's volatile. It's an asset class that's highly speculative. I agree with Katie.
Has it served? Do you think it's more and more serving as a proxy for risk? In other words, as almost the way the VIX index did as a proxy for risk in my youth.
Lawrence, yeah, wow, you're really modern. I'm so old school. I never got to VIX. But anyway, I think it is serving as a proxy. As I look at the markets and read the press, to some extent, it clearly is a proxy. Whether it's a good one or not, I don't know. But it does move as risk expectations change.
Steve, thank you very much for joining the show this morning. It's always such a pleasure.
Great to be with you. Thanks for having me.
That was Professor of Applied Economics at John Hopkins University and Senior Fellow at the Independent Institute, Professor Steve Hanke.